going on, everybody? Ryan Thompson, the Assumable Guy. This is the Assumable Guy Show. Today we're talking about your credit score. Specifically, what happens to it when you assume somebody else's mortgage. Does it even show up on your report? Does it ding you? Does it help you? This one's for the buyers who found a killer rate and are now sitting there wondering if taking over someone else's loan is going to mess up their credit. Here we go. So you found one of these assumable deals, a rate in the twos, maybe a 2.65% on a nice house. And somewhere in the back of your head, there's this little voice. Wait, I'm taking over someone else's loan. Does their stuff come with it? What if they had a late payment 2 years ago? Is that going to land on my credit? And doesn't a new mortgage tank my score anyway? Right? Totally reasonable. I get this question on a lot of calls. Here's what most people don't realize though. When you assume a mortgage, you are not inheriting the seller's credit history. None of it. Not their late payments, not their baggage, nothing. The loan gets transferred into your name and it shows up as a brand new account on your credit report, dated from the day you close. In other words, you step into the seller's interest rate, but you do not step into the seller's credit history. Two totally different things. So let me walk you through what actually touches your credit in this whole process. There's really only two moments. First, when you get pre-qualified. That's a soft pull. It does not ding your score at all. I can find out what you qualify for and it doesn't cost you a single point. So don't be scared to get pre-qualified. That part is free credit-wise. Then, when you're actually assuming the loan, the lender runs a real credit check to make sure you can handle the payment. That one's a hard pull. And yeah, a hard pull knocks your score down a little. We're talking a few points. Maybe 5, maybe less, and it bounces back in a month or two. That's it. That's the same exact thing that happens when you get any mortgage or finance a car or open a credit card. There is nothing special or scary about an assumption here. One hard pull, a few points, back to normal in a couple months, right? Now here's the part that actually matters. Does it help you or hurt you down the road? It helps you. And I want to make this super clear because a lot of people have it backwards. That new mortgage on your report is a big, healthy installment loan with your name on it, and every single on-time payment you make builds your credit history. A mortgage you pay on time is one of the strongest things you can have on a credit report. So a few months after you close, most people actually see their score go up, not down. The little dip from the hard pull is gone, and now you've got a mortgage you're paying like clockwork. And there's a bonus most people miss. Credit scores like Variety. If all you've got is a couple credit cards and a car loan, adding a mortgage rounds out your whole profile. A mortgage is the strongest kind of account you can have on there. So you're not just adding a payment you make on time, you're adding the kind of account that lenders love to see. Little what if for you. Say you're young, you don't have much credit yet, thin file they call it. Assuming a mortgage and paying it on time is one of the fastest ways to build a real thick credit history. You go from barely any credit to having a mortgage on your report. That's a big jump. And here's something a lot of people don't know. This is where the low rate does something sneaky good for you. Your assumed payment is way lower than a normal payment, right? Say you assumed a $400,000 loan at 2.5%. Your payment might be around $1,580 a month. A brand new $400,000 loan at 6.5%. That's over $2,500 a month. That's nearly $1,000 a month difference. And it's not just savings. It changes your debt to income ratio. Lenders look at how much of your income is eaten up by debt every month. A lower payment means a healthier ratio, which means when you go to buy your next property or a car or whatever, you got more room to borrow. So the low rate doesn't just save you money today. It literally gives you more buying power down the road. Think about that for a second. The same move that got you a sweet rate also made you look better to the next lender. Now, don't let anybody scare you off this. I've had people tell me a bank or some agent said assuming a loan is risky for your credit or it's complicated, it'll mess up your report. No, it's a mortgage in your name that you pay every month. That's it. Do not let someone who doesn't understand assumptions talk you out of a 2.5% rate over a credit myth. So let me tell you about Jeremy. Jeremy found a house he loved with a 2.65% rate, $15,000 down, and he was nervous because his credit wasn't perfect. He kept asking me, Ryan, is this assumption going to wreck my score? I've worked hard to get it where it is. We got him pre-qualified. Soft pull. Didn't touch his score. He qualified. When we went to actually assume the loan, yeah, his score dipped a few points on the hard pull. He texted me kind of freaking out. I told him, Give it a minute. Fast forward about 3 months after closing. Not only was that dip gone, his score was higher than when we started because now he had a mortgage he was paying on time every single month. Same guy, better credit, and a rate almost nobody can touch today. Here's a little hack for you while you're in the middle of one of these. The assumption takes 45 to 90 days. During that whole window, keep your credit still. Do not go finance a new couch. Do not buy a car. Do not open 3 credit cards for the points. I had a buyer almost blow a deal because he financed a bunch of furniture right in the middle of the process, and his numbers shifted on the lender. Just sit tight, buy the furniture after you close, keep everything boring until the keys are in your hand. And real quick, sellers, if you're listening, this works in your favor too. When a qualified buyer assumes your FHA or VA loan, that mortgage comes off your credit report. You get released from it, which frees up your debt to income and makes it easier for you to go buy your next house. So the assumption isn't just good for the buyer's credit, it cleans up yours too. So if you found one of these and you're worried about your credit, or you just want to know what you'd qualify for with a soft pull that doesn't cost you anything, hit up assumableguy.com or DM me on Instagram at the.assumable.guy. I'll run the numbers for you. No pressure, just math. All right, let's go get some sweet properties. I'm Ryan Thompson. This is the Assumable Guy Show. Next episode, we're getting into whether you can cancel an assumption once it's already started, what happens if you get cold feet halfway through, and what it actually costs you to back out. If you've ever worried about getting locked into something, you're going to want that one. I'll see you on the next one.